Hey everyone, in today's video, I'm going to go through 8 high dividend paying Canadian stocks that you could add to your watch list. So each of these stocks I'm going to be talking about today has a minimum dividend yield of 6%, which is really good starting yield on cost. Some of them actually have been increasing their dividend year over year over year. So that's just a starting yield. And hopefully in the years or decades to come, depending on what your investment horizon is, that can grow into 10%, 15% yield on costs, which really help to amplify long-term returns. So we're just going to get right into it. But before jumping into the first stock here, which you can see on the screen, please just give me a second to hit the thumbs up button. It really does help with the YouTube channel and getting these videos out to more people. So as you can see by the screen, the first stock here is BCE, which is Bell. Bell is a telecommunication company in Canada. You see here in the last year, their 1-year stock chart is down 10%. This company's been going through a bit of a tough period. Even over the last 5 years, the stock's only up 6%. Now, the good thing is the dividend yield on this stock is so high, approaching 7% here, that kind of small or limited capital returns isn't really the whole picture. You're still taking home the 6 to 7% dividend yield. But the main thing with BCE and other telecommunication companies, not just in Canada, but also the US, is just the interest rate environment. And these companies naturally, because they have to build out their networks, they have a lot of capex, they hold a lot of debt. So servicing that debt's gotten a lot more expensive. That's really hampered profitability. Also, just the bidding wars on some of the government contracts to build out 5G coast to coast has been extremely expensive, and there's some political pressure to keep bills down or flat. So increasing costs, pressure to kind of minimize revenue growth hasn't really paved out to be a really high optimistic outlook for some of these companies by investors. Just looking at their last quarter financials here, you can kind of see their revenues were up about 3%, EBITDA up about 2%, some one-time things impacting net earnings and whatnot, but free cash flow for the quarter, and I don't like to judge any company by one quarter, but was about $1 billion. So they're still generating lots of free cash flow, but they haven't really been growing in the last few periods. Looking at kind of their business and their key pillars of their business, you have the wireless division. So they have about, this is just net adds for the quarter, were 100,000 give or take. Their ARPU is about $59, which is their average revenue per wireless user. So essentially the average cell phone plan that they get paid from their users is $59 a month. Wireline, which is like internet access for consumers, and then Bell Media. So they own a lot of media properties, a lot of cable channels like BNN Bloomberg for one of them, but they own a ton of them, I believe, like CTV News, TSN, some other ones as well. So these are really the 3 cornerstones of their business. Looking at their EPS estimates, so pretty flat. They're expecting to do about $3.20 this year, $3.30 next year, about 3% growth. When I look at that in terms of a price to earnings multiple, they're trading right about a 17-ish, 17, maybe 16, depending on how fast they grow here. So they're trading right there in the high teens. So not a bad PE, but they're paying it all out in dividends. So on this one, I don't own Bell. I actually own some shares of Rogers. I'd be a bit concerned with their payout ratio being as high as it is, maybe hampering their ability to invest into the company further. But hey, if you are just looking for the highest dividend yield, you think they'll figure it out long term, you like the assets that we kind of just looked through here, maybe this is one to consider adding to your watch list. The second stock here is Enbridge. So Enbridge is an energy company. Lots of us pay Enbridge on a monthly basis, whether we realize it or not, for providing energy into our houses. This company, if I look at it long term here, has done extremely well over the long term. But if I look at it even in the last 5-10 years, it's really traded sideways. Once again, even though it's traded sideways, you have at least gotten a pretty high dividend, currently paying about 7.3% dividend yield. And they've been increasing it as well. In the last 5 years here, similar to Bell, up about 7% before the dividend payment. So one of the things with energy is lots of people are kind of concerned, what's the future of energy look like? This is obviously a potentially biased outlook, but they're kind of showing across oil, natural gas, wind and solar and other, which they kind of highlight by color. They think it's going to be continued growth in the decades ahead, which if that actually came true would be beneficial for Enbridge's business here. And then just some sound bites here. They're expecting about 5% growth in the medium term, which would be pretty solid given their current dividend of over 7%. And then right here is the interesting one. They've actually increased their dividend 28 straight years. So despite paying a 7.5% dividend yield, if you think that they're going to be continuing that, and it seems like they're planning on it since they're calling out consistency as a value driver and the dividend under that, then this is one that you can very quickly turn to 7.5 to 8.5 to 9.5 to over 10% yield on cost at least, as long as the energy market holds up and the story they're painting here comes to fruition a bit. So looking at the EPS on Enbridge, they're expected to do about $2.90 this year and next year. So on a PE, I think that's about a 15. If I do some math, if it was 3, it would be a 16. So yeah, like a 15, 16 times PE. Similar sentiment on Bell for me, or on Enbridge as Bell, where they're pretty much paying out all their free cash flow right now in dividends. So that's a bit concerning just in terms of servicing debt and other things, if they'll be able to meet those obligations at the same time as increasing the dividend. They're really counting on their category and prices to grow, in my opinion, in order to meet that kind of outlook. So this is one. I'm not an expert in the energy space. I actually don't own any like Enbridge or Suncor or any stock like that in my portfolio right now. Probably just have some exposure through ETF. So I'm not the most educated person to be speaking about it. But when I just look at it super high level like that, it just feels like their yield, while high and that's nice in the short term, may not enable them to invest long term based off of their dividend payout versus their EPS estimates over the next few years. Going into the third stock now, this is one that I do own. It is Pizza Royalty Corp. Talked about this one before, so I'll try to be quick on this one. 6.1% dividend yield. They pay out 100% of the royalties that they get from Pizza and Pizza 73 out to their shareholders. Looking at the company quickly, here they have a really big coast-to-coast presence, but primarily in Ontario. That's about half their locations, about 500 right there. And as we look at their locations overall here, you can kind of see the split that they've had. And it looks like they actually, I may be getting them mixed up with A&W. They actually have closer to 750 locations. So even more pronounced in Ontario, 500 out of 750. So you are getting a lot of Ontario exposure. Depends if you'd like that or not. But you can see they've been pretty good at adding restaurants over time. And each one of these restaurants provide another profit center, essentially, where consumers can come in, make purchases, and you're getting a certain percentage of that revenue sent to you in a check every month. So the more of these stores that open, the more profit that'll be coming to your way over time through the monthly dividend. Looking at the dividend yield here as well, you can see, or dividend payout, you can see that they've been paying a dividend for every single year, and even throughout COVID, they did drop it from 7 cents to 5 cents, and they slowly built it up as the revenue came back. So this is one of the good and the bad things about these royalty corps. They do not have any buffer for the most part. When revenues go down, the dividend will go down. But on the other side of the coin, as soon as the revenues come back, they need to pay all of those incremental royalties out to shareholders monthly. So you can see it came back just as fast as it left, and now we're actually at 7.5 cents, which is better than it was at the prior standpoints before COVID. Looking at the outlook here, they're expecting to make about $1 a share, and if we look at the fact they're going to pay about 7.5 cents a month, they're expected to pay out about 90 plus cents a share in earnings here in terms of dividends. So they're pretty much paying it all out. I like the stock. I think it's stable. I think it's somewhat recession proof, and I get nice monthly cash flow in my portfolio. So this is one that I have in my portfolio. You may want to consider adding it to your watch list, your portfolio, after you do a bit more research. Next high dividend stock here on the Canadian market is Scotiabank, 6.5% yield. I won't go into it too much because I've talked a lot about Scotiabank in the past, but one of the unique things about Scotiabank, if you want to pause, you can kind of see their revenue mix there, or earnings mix rather, but they do have a lot of Latin America exposure in their business. You can see here in terms of some of the markets they're in Mexico, Peru, Chile, Colombia, and you can see just some of their presence in each of these markets. They're one of the top 5 or 6 banks in each of those markets, taking a couple $1 billion of revenue from those markets. And in some of those markets, even though volatile, they have really high return on equity. So like Mexico, 25%, Peru, 15%, on average about 14%, which is okay, but being weighed down heavily by Colombia. So it does have a bit of a unique spin on this Canadian bank in particular, because of their presence in those Latin American markets. You don't get that very often with Canadian stocks. But looking at them from a PE standpoint, they're expected to do about $7, then $7.25 next year. So they're trading at about 9 times future earnings. So I think that's pretty cheap. I think they're able to pay out the 6.5% dividend, still have enough money to reinvest back in the business. And that's why this is another one that I do own on my end as well. Going into the next stock, it is Labrador Iron Ore Royalty Corp. Talked about this one a long time ago. It's one that I briefly owned, but then traded out of when it went up a good amount before I got a chance to build out a position. But essentially, this company currently has an 8% dividend. It is very volatile quarter to quarter, and that's because similar to royalty companies, it really depends on a couple things. Sorry, I meant to go to the slide here. They own 15% of the company that is producing iron ore out east, I believe, in Canada. And then on top of their 15% equity stake in the mine, they get 7% on the dollars of every dollar that gets brought into the company. And then they also have a volume incentive. So they get 10 cents a ton on all of the volume as well. So we're getting a volume incentive, a dollar incentive, and we own actually 15% of the underlying mine when we own shares of Labrador Iron Ore Royalty Corp. Their dividend spans from, I've seen it at $4 a share for a year all the way down to 25 cents a quarter. So it really does depend on the quarter, on the period, on the macroeconomy. Iron ore is really needed for building in mass. So China, and as China's built out their economy, has been a really big customer of iron ore, swaying the global markets, but it is a very volatile commodity. So it's one that if you're interested in it and you do more research in it, may not be one you want to make an overly large position, but it can provide pretty good dividend yields. And over the long term, it's actually performed really well, paying out 8, 9, 10% a year while also showing some capital appreciation. So congrats to people who have been investing in iron ore for a while. Looking at their earnings estimate here, they're expected to do about $3 a share, so trading about 11 times earnings at current valuations. The next stock here is Pembina Pipeline. So Pembina Pipeline trades at a 6.3% dividend yield. They own pipelines mostly in Alberta. You can see their stock price has been pretty flat over the last 5 years, but once again, that's pretty common with these stocks that are paying out the majority of their earnings and dividends. Doesn't really enable them to reinvest at any high degree to create further capital appreciation. So you're getting the dividends to invest yourself or spend, and it's obviously great if the company's creating value or their assets are just becoming more valuable in the meantime as well. But it's hard to expect these companies to grow at a very high clip while paying out such high dividends, or else they would be no-brainer investments for everyone. Looking into the company a bit more, you can see here some of their assets that they have. Says on the right-hand side, a bit of a legend. I won't go through all of it, but they're very heavily concentrated in Alberta. They have some business that flows down here into the U.S. You see it looks like they have a pipeline down to Chicago. They have a fractionator in Sarnia, which is still in Canada, but more Ontario than out west. But they have a ton of activity here in Alberta flowing into BC there. And then as we look at just their mix, they're primarily a pipeline company. About 60% of their revenue comes from pipelines, and you can kind of see the other things that fill in the blanks there. Looking at Pembina's earnings estimates, this is Pembina US, so I'm just going to quickly go to the Canadian one, just because we were looking at the stock price, and the stock price was about all over the place here, about $42. This one's kind of traded between $40 and $50 for a while. So on the lower end of where I've seen it, which is kind of propelling the yield up a bit higher. But yeah, going to be about $2.80 this year, closer to $3 next year. So on next year's earnings, trading about 14 times, give or take, the earnings. So a PE of about 14. So steady, not super low, but definitely not super high either. So a potential option for people looking for yield in a pipeline play. The next stock is Crombie Real Estate Investment Trust. So Crombie is actually the underlying real estate of lots of Empire Corporation's assets. So that is primarily Sobeys, Food Basics. They just acquired 50% of Longo's. They also acquired Farm Boy. So that's lots of the assets that they own. They kind of spun off their real estate division. If we look at just the REIT in terms of what kind of real estate do they own, you can see they're primarily retail here. They do $5.6 billion of revenue. And if I was to ballpark it, that looks a lot like about 80% just straight retail. Maybe 7-8% is industrial, but they say retail related industrial. So these are definitely like distribution centers for Safeway, for Sobeys, and other banners that Empire owns that now this REIT owns. They have a couple percent there mixed use residential, and then a couple percent for other and office space that they also own there. So primarily a retail REIT here. Another interesting thing is I believe Sobeys, or Empire rather, which is another stock traded on the TSX, still owns a huge percentage of this company. So they're incentivized to continue to grow with Crombie and continuing to use them as their landlord to go into development projects together and whatnot, because they still own the underlying security. They're getting paid a fat dividend check on a monthly basis that they're investing in their business as well. So they're all kind of aligned on the real estate side as well. Just want to show, whenever I go through REITs, I want to show a couple of the assets they have. So I just went straight to their property list, didn't filter by any location, just to scroll through, give you a bit of a feel for the types of assets that they have. Some stuff here I like, some stuff I don't like. Obviously, the office buildings, maybe a bit overdeveloped on this page, just because I saw it was only a couple percent of their total rent. But this is just kind of a look and a feel of the type of assets they own. You see lots of Sobeys, Sobeys, Dollarama here. So pretty concentrated portfolio on Sobeys. Here's kind of 5 in a row. And, historically, grocery has been a pretty good place to be. So maybe not a bad thing. And I know it's REITs like Choice Properties, which is Loblaw's old real estate arm, trades at a premium because of that exposure. Looking at their valuation here, so they do about $1 in funds from operations per unit. Going back to their valuation, their price is $13.50, so they're trading about 13.5 times funds from operation. To be honest, looking at other REITs, retail REITs in the space, this actually is a bit rich. So it's stocks like RioCan, who also has a lot of grocery anchored tenants, even more diversified than this, trades at closer to 11 times. Some other ones trade at 12 times. So 13.5 is probably actually on the higher end. I don't know much about the quarter to quarter, day to day. So maybe they have a lot of exciting things coming. Maybe they've had a lot of good momentum and rent growth or whatnot. But just from a comparable standpoint, that seems like a pretty rich valuation for a Canadian retail REIT. Going into the 8th and final high dividend Canadian stock, it is CIBC. So CIBC Bank currently yielding 6.4%. Looking at this one, over the last 5 years, down 12%. This is the most Canadian bank out of all of the big banks. They don't have a huge international presence. You can see here they're almost 3/4 in Canada, 15% in the US, 13% other. And then this is their net income by division. So 35% in Canadian personal loans, 33% in Canadian commercial banking, 35% in capital markets, which is also probably a lot of Canada in there as well. So big presence in Canada. They're one of the biggest mortgage books, or their relative mortgage book size is the biggest given their market cap out of all the Canadian banks. So they're really heavily invested in mortgages coast to coast on this one too. Looking at their earnings per share estimate, they're not going to grow, or they're not expected to grow, but they're looking to do about $7 of earnings per share. So they're trading at about an 8 times multiple. So super cheap valuation on this one. Maybe people are concerned that if the housing bubble bursts, CIBC will be most impacted. If that did happen, that's probably true. They have a lot of capital markets revenue and earnings, which is super volatile depending on the markets as well. So maybe that's a bit of a concern. But 8 times over the long term for these banks, I feel like is a great entry point to get in. These banks have all done really well over the long term. They're paying out huge dividends at this time, and they've never really cut a dividend. They've actually been growing the dividend year over year for the most part. So personally own this one as well and think it is an interesting entry point here near 52-week lows. So I went through that as quick as I could, but those are 8 high dividend paying Canadian stocks to consider adding to your portfolio or buying, doing more research on, whatever you want to do with these. If you like this kind of content, be sure to give this video a thumbs up. If you haven't yet, be sure to subscribe to the channel. And if you have other high dividend paying stocks you want to share with us, please let me know in the comments. Would love to hear about them and look at them as well. Thank you guys for watching this one, and I'll see you in the next one.